Welcome to Mind the Gap, a tale of two exemptions. I'm Jennifer McNeil Lozano, co-chair of the BHBA's Trust and Estates Law section. Before we begin, I'd like to take a moment to introduce Brian Joy of the Sanborn team. Nancy and Brian of the Sanborn team have been the official sponsor of this section since 2006, 20 years. Brian, say hello.
Thank you, Jennifer. Good afternoon, everyone. I want to give a quick update from the probate and trust real estate market. One thing we're seeing right now is that buyers are still very interested in properties that need repair or updating. Actually, some of the strongest activity we're seeing is on homes that most people would consider fixer-uppers. The difference is that today's buyers are very informed. They're looking at repair costs, insurance, interest rates, and renovation timelines before they make an offer. They're not afraid of the work. They just want to know the numbers make sense. What we're telling our sellers is that the market is still very active, but pricing matters more than ever. When a property is priced correctly, the buyers show up and compete. When it's overpriced, even a great property will sit. So despite what the headlines are saying, there's still plenty of buyers out there that they just want value. And when they see it, they're willing to act. Thank you, everybody, for your time. Enjoy the meeting.
Thanks, Brian.
Sure.
In addition to the Sanborn team, the Trust and Estate section is also sponsored by Bond Services of California, Liberty Mutual Surety, California Title Company, and Pickford Escrow Company. Now I'd like to turn things over to Leah Momcios to provide this month's legal updates. Leah?
Thank you, Jennifer. This month's legal update addresses the suspension of FinCEN's real estate reporting requirement. On March 19th, 2026, a federal judge in the Eastern District of Texas imposed an injunction against the enforcement of the Financial Crimes Enforcement Network's, FinCEN's, real estate reporting requirement created under the Corporate Transparency Act, which went into effect on December 1st, 2025. The federal judge held that FinCEN's reporting requirement for certain non-financed real estate transactions involving a transfer to a trust and other entities exceeded the authority Congress granted FinCEN under the Bank Secrecy Act. FinCEN's compliance page notes that in light of the ruling, quote, reporting persons are not currently required to file real estate reports with FinCEN and are not subject to liability if they fail to do so while the order remains in force, end quote. FinCEN has since appealed this ruling, but in the interim, practitioners are not currently required to file FinCEN reports for trust transfer deeds or for other real estate to entity transfers. That's your legal update for June 2026. Over to you, Rosita.
Hi, I'm Rosita Jacobi, Assistant Program Co-Chair of Beverly Hills Bar Association Trust and Estate Law Section. I'm delighted to introduce our speakers, Amy Takeuchi-Wanlas and Elizabeth Glasgow. Amy Takeuchi-Wanlas is a Senior Director of Family Office Planning at BMO Wealth Management, bringing over a decade of expertise in estate planning, tax advisory, and complex wealth transfer strategies for individuals and families. Prior to joining BMO, she served as Senior Vice President and Senior Wealth Advisor at Northern Trust and as a Senior Wealth Planner at Wells Fargo Private Bank. And earlier in her career, she practiced as a trust and estate attorney at nationally recognized law firms, including Venable, LLP, and Mitchell, Silverberg and Knott, LLP. Amy holds a JD from UCLA School of Law and a BA in History and Theater from UC Davis, and is a member of the California State Bar. Elizabeth Glasgow is a partner at Buchalter and national co-chair of the Trust and Estate Group, where she advises ultra-high net worth individuals, families, and entrepreneurs on complex wealth transfer strategies, tax minimization, business succession planning, and charitable gift structures. A fellow of the American College of Trust and Estate Council, Elizabeth is consistently recognized as a leading authority in her field, having been repeatedly ranked as a top California attorney by Chambers High Net Worth and honored nationally by the best lawyers in America. She's a sought-after lecturer on complex wealth transfer and tax strategies, with recent presentations at the American Bar Association, the USC Tax Institute, and the National Association of Estate Planning Councils. And now let's get started.
And most importantly, the Beverly Hills Bar Association. Thank you everyone for having us here today. Amy and I are really excited to bring this presentation. We'll be, asking for the slides to be advanced, but we're delighted to kick it off.
Thanks, everyone. Today, we're going to talk about estate, gift, and GST tax planning in a post-OBBBA era. And we're using a simple idea as our framework, which is mind the gap. Now, many of you have probably heard that phrase before on the London Underground, and you're thinking, what does that have to do with estate planning in the United States? Well, really, it's just a fun way to remind us to be mindful of the mismatch that can sometimes occur between an individual's lifetime exemption amount, gift and estate tax exemption amount, and their generation skipping transfer tax amount. So our goal today is to make that gap more visible, to walk through where it comes from, where it tends to show up in planning, and how to address it when a gap does appear. So the first slide here is our journey today. It's our route map that we hope to cover with this presentation. So we'll start with a short reminder of where we started prior to OBBBA, and then move on to post-OBBBA and the new $15 million permanent exemption. From there, we'll do a bit of a deeper dive into GST generally and the various allocation rules. And then we'll look at some common scenarios that tend to create that gap between the estate and gift versus GST. After that, we'll work through some planning opportunities to shorten that gap during life. And if that's not possible, then look at some post-death opportunities to address the gap. And finally, we'll take a look at a practical checklist and some takeaways. So while OBBBA gave us more certainty with exemption amounts, it certainly didn't eliminate the complexity regarding potential mismatches between estate and gift and GST. So the train schedule may be clearer, but there are definitely some still missed connections. And today we hope to illuminate some ways to fix some of those missed connections. So next slide, please. We're going to look at the pre-OBBBA landscape. So in 2017, we know that the Tax Cuts and Jobs Act gave clients a significantly increased exemption, but that did come with an expiration date. And we know that expiration date shaped behavior. It created urgency, it pushed clients and advisors towards rapid gifting strategies. And, when planning is done under pressure, some of the first things to get lost are often the most technical items, things like GST allocation, inclusion ratios, and whether or not a trust is actually GST exempt. So this slide, we're just looking at a little bit of where we started with the Tax Cuts and Jobs Act. So in 2017, the exemption was at about 5.49 million. And then we know Tax Cuts and Jobs Act increased that. So by 2018, that exemption had doubled, to about 11.818 million. By 2025, we were up to 3.14 million, basically. But everyone knew that under the Tax Cuts and Jobs Act, we were looking at a potential drop starting in 2026. And, that would have been cutting the exemption somewhere back to around 7.1 million. And this is the time period we remember as the use it or lose it environment. So clients were funding slats, dynasty trusts, idiots, and other structures really quickly. And in many cases, that was definitely an appropriate planning technique. But now that we no longer have that looming threat of a sunsetting exemption, there's definitely time now to sort of look thoughtfully at clients' estate plans and see where the estate gift GST exemption mismatch may currently exist in their plans and explore ways to close that gap. So Elizabeth is now going to take us through our post-OBBBA landscape and what we're looking at currently.
Yeah. And this really was sort of a day of independence for all of us in the estate planning world. July 4th, 2025, with the adoption of the One Big Beautiful Bill Act is that the opportunity became available for us to calm down. We had lived through a number of, sunset fears up until this point. And as Amy was saying, clients were probably getting pretty tired of us saying that the sky is falling and the exemption is about to change and we have to hurry up and do something. So now that we're in the new environment starting January 1st of this year, we have this nice round $15 million exemption. This is one of my favorite parts of the new law, is that I'm not trying to constantly tell clients that these very specific non-round numbers and get them to remember it. 15 million just rolls right off the tongue. We have continued the doubling of those transfer tax exemptions available for married couples. So we have almost $30 million, not almost, around $30 million exactly of an amount of exemption that couples can utilize. And as Amy said, we're not dealing with sunset anymore. This has been a tremendous relief to myself, and I'm sure all of us, to be able to speak with clients in a more calm environment and really evaluate future planning that they'd like to do without necessarily that rushing deadline. We are looking for, unfortunately, the end of that nice round $15 million number starting next year, when we will see the annual index for inflation on the $15 million transfer tax exemptions. Who knows what that will necessarily look like, but it will be tagged going up from 15 million starting in January 1st of 2027. Two of the major things that have not changed from the prior rules is that we continue to have our annual exclusion gift amount that has stayed at the $19,000 number. Although I suspect we all think that with the inflation adjustment of that number next year, that we will creep over into $20,000 for annual exclusion amount for gift recipients. And the transfer tax rates remain unchanged. So across, gift, estate, and GST tax, we continue to have a 40% tax rate. Next slide, please. The changes are very beneficial, but what we didn't see change were some of the major topics that we'll discuss during the presentation that relate to how it is that these exemptions operate in coordination or lack of coordination with each other. So items that are still on the platform that can cause gaps are the automatic generation skipping transfer tax exemption allocation rules. These can be traps for the unwary as a mechanism to try to help taxpayers by applying GST tax exemption, but it may not always be as thoughtfully done as we would like it to be. We still have that the GST tax exemption is not portable between spouses, so there's still an opportunity for one of the tax exemptions to be lost. We've also got a continuation still under these current rules that the 706 filing rules for clients that do want to take advantage of the portability of the estate tax exemption, that process and procedure still exists the same way. That's unchanged. As I mentioned, the rates remain unchanged. And, one thing that we don't necessarily think a lot of here in California, but to be mindful of because clients, may have assets in other jurisdictions, or you may be working with someone who's relocating, state estate taxes are not affected by this. This change in the law with the OBBBA was a federal change. So we're going to review just quickly at the end some of the state tax considerations that are still present. Next slide, please. This slide, honestly, we just threw it in because I think it's so remarkable to see how tremendous the exemptions have changed. We mentioned the idea that the estate and gift versus the GST tax exemptions are uncoupled, meaning that although they happen to be the same amounts in this period of time and have been increasing at the same rate, they are uncoupled in the sense that they are used independently. An opportunity to use one does not necessarily mean that you have to use the other. And that's what we're going to be predominantly talking about today. But I love looking at this to appreciate that in such a short, dramatic time frame of just 10 years, we've seen an almost tripling of these transfer tax exemptions. And it's really remarkable to think we can see that degree of change in such a short time. And so to some extent, as we appreciate now at the far end of the diagram, that we have $15 million in exemptions or $30 million for a married couple, to some degree, that may make this presentation less interesting. And maybe I shouldn't spoil that at the beginning. But, for all of us who are aware that with exemptions being so large, the vast majority of, taxpayers are able to do all of the planning that they're interested in doing, well within that exemption, potentially well within, just one family member's exemption, not even needing a spouse's exemption to do the kind of transfers that they're able to do with their net worth. So to kind of focus on the topic for today, which is times where we are seeing exemptions varied from each other, where we're going to talk about planning opportunities for utilizing kind of the mismatch between the two exemptions. This is very much for a select client audience, right? This is not every taxpayer. These are taxpayers with a net worth far, at least at, if not in excess of these exemptions, so that the fact that these mismatches are occurring is something that's relevant to them, that they want to pay attention to or resolve if they have an existing mismatch. So we just want to put that in context that, this is not necessarily a topic that will be motivating for all of your clients, but still for those who are at a net worth size where this is relevant, we really want to pay attention to the fact that the exemptions can be decoupled. Next slide, please. So Amy, do a quick review for us of, just GST tax world in a little bit so that we can talk more fully about some of the variations.
Yes, now we arrive at the fun transfer tax planning technical side. So we're going to look at the different types of GST transfers, a reminder about inclusion ratios, and looking at the automatic allocation rules. So there are 3 types of GST transfers that are important to identify at the outset. And just as a reminder, as a level set, a skip person is generally an individual who is a generation at least 2 levels below the transferor. So, most commonly, we're looking at a grandchild here. And the first category of transfer is what is known as a direct skip. So it's a transfer made directly to a skip person, either during life or at death. Again, that straightforward example is outright gift from a grandparent to a grandchild.
And I think,
although I was going to say, I think Elizabeth has a little bit more she wants to expand upon on that point.
Yeah. And this is, so one of the notes that we've made about direct skips is that we also have circumstances where a trust itself can be the recipient of a direct skip transfer. So if the trust is only benefiting skip persons, this is a scenario where the transfer itself will be a direct skip for GST tax purposes. There's a variation on that, though, that I want to spend just a minute talking about before we move on to the other types of GST transfers. And that's to be thoughtful about how a trust is structured for not necessarily the application of the GST exemption, the larger $15 million lifetime exemption, but to question whether or not the trust might be structured in a way that could use the smaller GST annual exclusion exemption. So among the other rules that didn't change with the new law is how the annual exclusion gifts worked. I mentioned that they are both still at the $19,000 annual exclusion amount, and how that exclusion is applied to either the gift tax concept or the GST circumstance has also remained the same. And we all know that in lifetime gifting for gifts to a trust, the ability to utilize an annual exclusion benefit in a trust requires a beneficiary to have a present interest, a withdrawal right. Fairly straightforward. We see that quite often. It's a little bit of a different rule, in fact, much stricter rule for utilizing a GST annual exclusion. We have the same concept of an annual exclusion. So a gift directly to a grandchild, to another skip person, can use the same $19,000 annual exclusion. If it's made to a gift in trust, though, the annual exclusion rules are much stricter for the GST tax annual exclusion. Specifically, the idea under Section 2642C that the nature of the trust is very important. We still need to have that present interest withdrawal right, but the trust itself has to have certain characteristics. It has to be only for the benefit of that skip person beneficiary. It must require that they receive all of the trust during their lifetime, or if they've not received all of the trust assets during their lifetime, that the trust assets are includable in their estate for generally through a general power of appointment. And so this special rules around GST annual exclusion, we're going to come back to, but I just want to mention them in the direct skip context because a trust itself may be a direct skip recipient, even though internally within the trust, the annual exclusion GST tax rules may not apply.
Thanks, Elizabeth. So continuing on the types, oh, we're still on that slide, sorry, on the types of GST transfers. Another category would be a taxable distribution. And so this arises when a trust has both skip and non-skip beneficiaries. And then a distribution is made to a skip person. So in that case, the tax consequence depends on not necessarily a new allocation of GST at the time of the distribution, but on that trust's existing inclusion ratio. So how much GST was already allocated to that trust. And then finally, the third category is a taxable termination. And these occur when the non-skip interests in a trust terminate. So that at that point, the only beneficiaries of these trusts are skip persons. And again, the tax result turns on the trust's inclusion ratio. So if the trust isn't fully GST exempt, then GST tax would be imposed at that point. Okay, now moving on to inclusion ratios on the next slide. Great. So an inclusion ratio tells us how exposed a trust is to GST tax. So over here on, well, it's my left-hand side, the green side, an inclusion ratio of 0 means that the trust is fully exempt. And typically that's our goal, no GST on future distributions to skip persons. An inclusion ratio of 1 over here on the right-hand side in red means that the trust is fully exposed. So every taxable distribution or termination is subject to GST at the applicable rate, which we all know is currently 40%. So this can happen for a number of reasons. Maybe it's a trust that for some reason the grantors affirmatively elected out of GST allocation. So these trusts do exist, and at least GST taxation of these trusts is fairly straightforward. Now I would say the more annoying trust is the one with a mixed inclusion ratio, and that's the one in the middle. So just quickly going off the example on our slide is, let's assume grantors have allocated $500,000 of GST tax exemption to a trust, but maybe the return is filed late and the trust's fair market value at the actual time of allocation is now $600,000. So that would produce an inclusion ratio of approximately 0.167. And what that effectively means is that 16.7% of future distributions from the trust will be subject to that GST tax at 40%. And this is why partial inclusion ratios are so problematic. They can be easy to overlook, but they create really annoying ongoing complexity and recurring transfer tax exposure. And, a lot of times these aren't created intentionally. They result from late allocations, missed elections, valuation changes, or et cetera. There are definitely ways we can alleviate this. Sometimes we'll look at doing a qualified severance and split that mixed ratio trust into 2 separate trusts. So one is going to be fully GST exempt and the other one fully non-exempt. But the basic takeaway from this is that, for any trust that can benefit skip persons, the inclusion ratio should definitely be calculated, confirmed, and documented, hopefully. Because without that analysis, it's difficult to sometimes know whether that trust is GST exempt or if it only appears to be. Moving on to the next slide of automatic allocation. So the automatic allocation rules were initially designed to help taxpayers, but I think sometimes they also create a lot of chaos. So for direct skips, automatic allocation is generally on. For outright gifts to skip persons, including many annual outright exclusion gifts, GST exemption can be automatically allocated. For indirect skips, like transfers to trusts that may benefit skip persons, automatic allocation is also generally on unless the donor affirmatively opts out. Now, this can be helpful, but the automatic allocation can sometimes waste GST exemption on a trust that may never actually benefit skip persons, or maybe it's a trust that holds assets that might not appreciate as much as assets in a different trust that the grantor may want to create in the future. Another automatic allocation we have to think about is when we have Q-tip trusts. And actually, automatic allocation is generally off on these unless a reverse Q-tip election is made. Otherwise, the decedent's GST exemption can be lost because the surviving spouse actually becomes the transferor for GST purposes. And finally, we have a 9-month post-death issue. So if no GST transfer occurs within the relevant period, automatic allocation may not save the plan. So I think the big message is automatic doesn't mean optimal, automatic doesn't mean thoughtful, and it definitely doesn't mean that the IRS has kindly handled this for us. So now that we have a bit of a background on GST tax or generally, we're going to start looking at some common scenarios where a mismatch occurs between gift and estate versus GST exemptions. Next slide, please.
So creating the gap, as even just talking about how complex these rules are, it becomes pretty apparent that the gap creation can happen quite unintentionally. So if we go to the next slide, we'll kind of walk through how the gaps are being created. And we want to spend time focusing on this because when we sort of get to the tail end of the presentation, talking about how to merge the gap back together and kind of reclaim disconnects and exemption, many of the things that may have caused the exemption unintentionally can now be utilized purposefully to cause the gap to come back together. So we're going to spend a little bit of time really going into detail on how the exemption gaps are created in the first place. And we'll start first with the idea of a circumstance where a client has more GST tax exemption than they have of estate and gift tax exemption. And this is sort of the low-hanging fruit of this discussion because it's something I think every single one of us has experienced. A client comes in, for a first meeting, and in the process of onboarding, you learn more about their history of gifting, which has included a number of, generous gifts to children, non-skip people. And, they're very proud of these gifts, and it is wonderful and generous of them to have done so. But by definition, having made these gifts directly to non-skip people, they didn't need to utilize any of their GST tax exemptions to protect those gifts from transfer tax. And so right off the bat, you're already working with a client where we have a disconnect. That is not to say that this disconnect is problematic. I'm sure their children are very grateful for those gifts that were made, but it has from day one put you in a circumstance of seeing this discrepancy. So, an easy one to start off with, just to explain, this is one of the first and most often ways that we start to see this particular mismatch.
Yeah. And another common way that we see more often now too is, with the advent of portability, a lot of clients do have what I would call a portability only plan. So let's assume the first spouse dies, they leave everything either outright to the surviving spouse or all to the survivor's trust. And from an estate tax perspective, that may seem entirely reasonable. If a timely 706 is filed, the deceased spouse's unused estate tax exemption can be preserved through portability and carried over to the surviving spouse as DSU. The problem with that is that GST exemption doesn't work the same way, unfortunately. As we all know, it is not portable. So it doesn't transfer to the surviving spouse just because an estate tax return is filed. And it doesn't survive indefinitely, if it's not affirmatively used. So that's oftentimes how we see a mismatch. The surviving spouse now has a substantial estate tax exemption available, but they only have their own GST exemption remaining available for planning. And, I see that a lot when surviving spouses come in and they want to now create structures for grandchildren, et cetera. And at that point, sort of everyone assumes, oh, we've preserved all of the exemption. But unfortunately, in reality, we've only preserved the estate tax exemption. So the GST side was not preserved. So that's another very common way that I see the mismatch between GST and estate and gift.
And in a perfect illustration that this presentation was actually prepared by Amy and myself and not by AI, please note that that wonderful description that Amy just gave is meant to be on the other side of the chart because it is a circumstance of the estate and gift tax exemption being larger than the GST tax exemption. And so nothing is perfect. But so continuing on the blue side for talking about GST tax exemptions that are bigger than a client's available estate and gift tax exemption. We actually also have a purposeful time where you may be wanting to create this exemption mismatch. And this deals with late allocation of GST. So we're familiar with the idea for gifts made into a trust that the GST tax exemption can be applied, at the time the gift is essentially made on a timely filed gift tax return. But there's an opportunity that, you can be attentive to in terms of like what has happened to the value of that gift in the intervening time since the gift was made. Now, this part would not be intentional, but if the assets have unfortunately depleted in value substantially, so a promising gift has not really come to fruition, and unfortunately now in the following tax year, as it's time to file the gift tax return, it becomes apparent that there's been a substantial decrease in value, a lot of volatility, whatever it is that has now put the client in sort of a remorseful position that they have used essentially their gift tax exemption in making this transfer, and it may not turn out to be as successful as they thought it would be. So in this circumstance, there may be an opportunity by doing a strategic plan to opt out of GST, make a purposeful decision not to apply GST to a trust recipient, and then choose to do what's called a late allocation of GST. Late allocation means that after having concluded the period for timely filing a GST allocation, you then at that point in time file essentially a supplemental gift tax return applying GST allocation as of the value of the assets inside the trust at that time of the filing. Why this kind of works for a trust that has been funded, in the prior year with assets that have depleted in value is that if the original gift was, $1 million gift into a trust, unfortunately it's worth only $600,000, say in April or October of the following year. The decision could be to say, let's affirmatively not apply the $1 million of GST tax exemption that otherwise would be necessary and do a purposeful late allocation, at a time point where, we think hopefully this will not hit rock bottom, but will be, some period of time less. And at that point, use only the GST tax exemption that's necessary to cover the gift at that time. Now, obviously, this is a difficult conversation to have with clients. They're probably already pretty upset that the asset has declined in value, but it is something to let them know that we're doing everything we can to kind of preserve the exemptions that they do have. Knowing exactly when to make that late GST tax allocation, though, is difficult. On the one hand, once you've introduced the concept of timing, of course, the client may be trying to think about when would be the ideal time to make this, supplemental now late GST allocation. Trying to identify that perfect moment where it will be as low as possible to use the least amount of their GST. This would, of course, result in them having much more GST tax allocation remaining to them than they do of their estate and gift. One word of warning with this transaction, though, is that it does have to be very carefully timed, not just timed from the perspective of what the value or decreased value of the asset is now that it's inside the trust, but also considering what does it mean to be filing a late allocation of GST after the conclusion of the time period for filing a timely gift tax return. You have to first file your timely gift tax return to have opted out of the GST before you can then subsequently file late. Where I've unfortunately had a client who ended up in a bit of a pickle on something like this is our new, frankly, world that we live in with the frequency that we see disaster extensions, major weather patterns that are establishing IRS timelines where the traditional April and October deadlines that we're used to may not apply. So if you're ever in a circumstance with a client considering this technique to kind of purposely create this mismatch, be very clear that you understand, where your client is located and physically where they're filing and using an address to report their gift tax returns, because it may be that they have an extension towards another period of time months later. You have to let the entirety of that timely filing run out before you can make the late GST tax allocation. But Amy, walk us through one of the other times that we're seeing more GST than estate and gift available after we've created the gap.
Yes. So from an estate and gift tax perspective, we usually talk about zeroed out grats that use none of a grantor's estate and gift tax exemption. But grats can actually be structured so that they're not fully zeroed out. Maybe they do use some of that grantor's gift exemption. But because of that estate tax inclusion period or the ETIP rules, GST exemption generally can't be effectively allocated to a grat while that grat is still making annuity payments back to the grantor. So in other words, the donor can create the grat today, but they can't lock in that GST exemption to shelter that remainder trust during the grat term. And so that's where we can see the mismatch occur. A grantor has used at least some gift tax exemption to create that grat, but there's no GST allocated to that gift at the time of the funding of the grat. So effectively, this leaves a grantor with more GST exemption than their estate or gift tax exemption.
So flipping now to look at the exemption gaps on the other side, where the estate and gift exemption is the larger of the two. How is it that this has come about? And this may seem like a silly point to talk about, but it actually was the kind of seed of this entire presentation idea. And this is the crummy trust. So in crummy trust, as we talked about earlier with annual exclusion rights, you have individuals who are have a present interest right of withdrawal that allows annual exclusion gifts to protect from transfer taxes gifts that are coming into this trust. But as I discussed earlier, under 2642C, to be able to utilize annual exclusion gift rights, the style of trust has to be very specific, and it's not really the style of trust that we're seeing for most of our life insurance trusts and traditional slats and gift trusts. And so why this becomes really important is that a client who may be believing in funding, a somewhat routine life insurance trust, for example, if they think, oh, I'm only ever giving gifts of the annual exclusion amount, my two exemptions remain, aligned. And that may not be the case if there have been the structure of that recipient trust is such that either the client is subject to automatic allocation rules as a trust that has, potential skip beneficiary members, or if it is a trust that the client is voluntarily applying GST tax exemption to. In both cases, though, because of that mismatch in how the annual exclusion gift rules work, we will see a mismatch in exemption where the GST tax exemption is going to be reduced more in the funding of those gifts. Now, again, in the sort of new environment where exemptions are so high, the first reaction might be, okay, these types of trusts, crummy trusts now, maybe they're a little leaky. Yes, they're using a little bit more GST tax exemption than estate and gift, but who really cares? 15 million is a pretty big number. And that may be true. And perhaps clients with, families of a certain size or have structured their trust with a certain number of beneficiaries, they may feel that that's an acceptable degree of mismatch that they're going to take. But I always kind of think back to a particular case, I think it's almost 10 years old now, a tax court memorandum case called the Mickle case. And it always stuck with me because of how just substantial it was. And it was a life insurance trust that was at issue that had 60 withdrawal rate beneficiaries. And when you think about that trust, if it's still in operation today, essentially they'd be transferring every year about $1.1 million of value, assuming even that it's not gift split, a single donor transferring almost $1 million in value, through annual exclusion gifting. But that could be a dramatic reduction in the GST tax exemption that was available if the family wasn't thoughtfully considering either the fact that the GST annual exclusion was not applying and that they would need to opt out of it, or that they were potentially in the reverse, purposely going to allocate GST, and then we'd be in the mismatch on the opposite side with a lot more GST tax exemption than estate and gift. So, again, crummy trusts, they are personally one of the banes of my existence because I find so often that they're creating these small amounts of discrepancy. And when you consider, though, that it's year after year, those leaky small amounts can become quite substantial over time.
So another mismatch that often occurs is allocation to a GST trust, a late allocation. So on the flip side of a GRAT that has been created and used some gift exemption, another way to look at GRATs is that they create a situation where we've used little or no estate tax or gift exemption. But now, if we want that resulting trust to be GST exempt because it's been so wildly successful, then we do have to affirmatively allocate GST tax at the end of the ETIP period, if the trust isn't subject to automatic allocation rules. But this type of allocation means that we're hopefully using a large amount of the donor's GST exemption since that trust has been so successful, while we've used very little estate tax exemption to initially create that trust. So again, here's another area where that mismatch can occur, leaving us with more estate tax exemption than GST. And a broader point is that even when the late allocation is beneficial, it does change your exemption picture. So if no one's tracking these exemptions, it can be easy to miss the fact that the client has now significantly less GST exemption remaining than their estate and gift tax exemption.
This next one is one that I'll in candor say, I didn't know this rule until Amy educated me about it. And then, of course, I ended up being the one to talk about it. So the slat gift splitting example is one that is, I don't think commonly understood about one of the particular rules where, again, we see a difference in how GST tax rules apply than how they're applied in the gift tax context. So we're familiar with gift splitting, right? The idea that a married couple, there can be a single donor spouse and a non-contributing donor spouse can essentially allow their gift exemption to be used towards the gift that is being made, to split the use of exemption and gifts. With the sort of magnitude that we've seen as exemptions have gotten bigger in families that are using spousal lifetime access trust, where a spouse is a beneficiary of the recipient trust, one of the questions that has come up often is, whether or not gift splitting can be used and how it would apply. So gift splitting, although it's generally not often used in slats, the reason is because there is still the option to gift split, except for the portion of the slat that represents the spouse's interest in the trust that's ascertainable and severable. So depending on how that slat was structured, it is possible to say that gift splitting is available for some portion, just not the portion that the spouse themselves is a beneficiary of. And so where this becomes relevant, however, is that you can have for example, $1 million gift coming into a trust. Let's say the spouse's ascertainable and severable interest, the IRS would determine is worth $300,000. So we have this $700,000 amount that's available for gift splitting. However, there's a different rule in the GST context that for gift splitting, all of the GST tax exemption must be equally split. So while the donor spouse is carrying more of the burden because they have to cover all of the portion with their own exemption for the spouse's interest that's ascertainable, and the non-donor spouse is only splitting half of the remaining portion that they are not part of, each of the spouses is contributing half of the GST exemption. So for the spouse, in both cases now, we've created a mismatch on both sides. The donor spouse is going to be using more gift and estate tax exemption and less GST tax exemption, and the flip will be the case for the gift splitting spouse. They will have used much less of their gift and estate tax exemption, but much more of their GST tax exemption because of this disconnect in the rules. Thank you, Amy, for telling me about that rule.
Anytime. So finally, the last example we wanted to go to was an allocation of GST to a lifetime Q-tip. So in a lifetime Q-tip structure, the donor makes a transfer to an irrevocable trust for the benefit of a spouse. And if the trust is properly structured, that transfer can qualify for the unlimited marital deduction. So that means the donor can make a transfer without using gift tax exemption. So from the standpoint of gift tax, that transfer is essentially exemption neutral. But GST planning can introduce a different layer. So let's say the donor wants the trust assets to continue for descendants after the spouse's death without future GST tax. In that instance, the donor can allocate GST exemption to that trust. And typically that's done on a timely filed 709 together with a reverse Q-tip election so that the donor, not the spouse, not the beneficiary spouse, but the donor remains the transferor for GST purposes. And so that's sometimes where that mismatch can come from. The donor at that point has made a transfer that uses no gift tax exemption because of the marital deduction, but the donor has nevertheless actually used their GST exemption to create a GST exempt trust for later generations. So that's just, some of the common ways that we see these mismatches between GST and estate and gift transfer tax coming up.
Next slide. But we didn't want, obviously, to just, make you aware of all these differences. We do think it's important to understand the nature behind why these are happening without also talking about, all right, how would we potentially reverse some of these and bring back symmetry? The symmetry can be important because sometimes for additional planning that you'd like to do, knowing that you're really working with the same amount of both exemptions can be really helpful because these mismatches, just before we talk about some of the solutions, an example of a foot fault I almost had was sort of assuming that a client had matching exemptions. Again, why I say crummy trusts are the bane of my existence is because it was due to a crummy trust that they had a much lower GST tax exemption. We were preparing to do a significant Wandry gift. Wandry gifts are the gifts by formula, where oftentimes the description of the formula is to say that you're making a gift to utilize or that is equal to the taxpayer's available maximum gift tax exemption, and was somewhat innocently working along on that assumption, and fortunately at the 11th hour was doing a more substantial analysis of a previous history of gifting and realized that if we proceeded with that gift as is, we would have ended up with a gift that was made that under Wandry, yes, would have been a gift that was free of any gift tax exemption, but going to a trust that would have had a pretty unfortunate inclusion ratio because there was just enough shortfall in the taxpayer's GST tax exemption that we would have had to do a lot of cleanup at the back end. So by going through this really thoughtful review of what the exemptions were, that there was a gap, we were able to avoid, pretty serious foot fault and revise that Wandry gift to say, the statement of the gift will be the lesser of the client's available gift tax exemption or their lower GST tax exemption. And so that opportunity to be aware that these were happening was a real saver in that point. But we want to now kind of pivot and talk along the changes that we can do proactively when we have clients who are in this circumstance, and we want to kind of bring them back into parity.
Yeah, so our first example is on the next slide, which highlights a somewhat counterintuitive planning point. So in the right circumstances, paying the gift tax during life can actually be more efficient overall than waiting to incur estate tax at death. And the reason for this difference is because of how the two taxes are structured. So gift tax is tax exclusive, which means that the tax is paid from assets outside of the gift itself. Whereas by contrast, estate tax is tax inclusive, meaning that the dollars used to pay the tax are themselves part of that taxable estate. So using the example on this slide, let's say a donor has excess GST exemption and they want to allocate it to a trust to make that trust GST exempt, but they've already used up all of their gift tax exemption. So if the goal is for the trust to ultimately receive $100,000 and that transfer is made during life, then the donor can transfer that $100,000 to the trust and pay $40,000 of gift tax separately. So in total, the donor has parted with $140,000, $100,000 to the trust, $40,000 to the IRS. But at death, this math works a little differently. So because the estate tax is tax inclusive, the dollars used to pay the tax are themselves part of that taxable estate. So if the client wants the trust to end up with, again, $100,000 after estate tax, then the estate needs to contain $166,000 because at a 40% estate tax rate, $66,000 goes to tax and only $100,000 remains for the trust. Now, this is definitely not a strategy for every client. It does require that the client have the liquidity to pay that gift tax during life. But in circumstances where the client has that excess GST exemption, and the goal is really to fund a trust for descendants the most tax efficient way, paying the gift tax can be a very rational strategy. And, I hear clients say all the time, you want me to pay tax now? But the answer is maybe, because paying this tax now may actually be more efficient in the end. So that's one of the ways to use a donor's excess GST exemption during life.
Next slide, please. So another technique that's I think of as kind of a sponge to soak up extra GST tax exemption is to look back to the technique we were talking about earlier related to grats. So we discussed the idea that a grat, particularly if it's structured as a zeroed out grat or very low gift-sized grat, must wait until the conclusion of that term to apply its GST, or for the donor to apply GST tax exemption, and see basically if the grat was successful, how much GST tax exemption is needed to protect the gift now that the grat period has closed. This was exceptionally popular in sort of 2022, 2023, when we were looking for clients who had sunset on their mind that was coming up on December 31st of 2025. And they were saying, well, if I have a circumstance where I have this unused GST tax exemption that is going to be wasted, I do not want to do what Amy has just suggested and just pay gift tax and make these gifts that will, unfortunately cause me to pay tax, but I don't want to leave my GST tax unused. I want to use that allocation while it's available to me before the sunset occurs. These relatively short-term grats were a great opportunity to give a client a chance to use that extra GST tax exemption, because the gift at the front end, if the grat is structured in a way that is what we call zeroed out or has a very low sized gift, we can then have the opportunity to wait and see. And apply our GST exemption at the conclusion, where that's all we're applying at the tail end. Now, again, this is not going to be perfectly timed. Some of my clients who did this, their grats performed even better than we anticipated. And though while it did end up using their excess GST tax exemption, ultimately the total success of the grat even exceeded their available and excess GST tax exemption. So we did end up with circumstances where we had essentially at the grat's conclusion, one fully GST exempt trust that we applied our remaining GST exemption to, and another trust that was not. We did, sort of the model that Amy's referring to of having a severance between the two distinct trusts. But at least, we gave them an opportunity to utilize that excess GST tax exemption in a circumstance where sunset was looming and we were at risk of losing it. We're not in that environment anymore under the new laws, but as we all know, legislation can change anytime. And so who knows how long this permanent law will be in place. Next slide, please.
We already talked about this a little bit briefly earlier, but when a donor has, again, excess GST exemption, what they can do is create a trust for their spouse that's designed to qualify for the marital deduction. And then, as we know, they can make that transfer without using any of their gift or estate tax exemption. And then they can allocate their remaining GST exemption to that trust. In order for this to work, typically the donor does have to make that reverse Q-tip election on a gift tax return, so that, again, the donor remains the transferor for GST purposes, which means, that the donor's GST exemption can sort of attach to that trust and protect it as it continues for descendants. So this structure does create I mean, uses that additional GST exemption because we don't have that gift tax exemption to make the initial gift, and then we use the donor's remaining GST exemption to create that GST exempt trust.
Next slide, please. So one of the kind of final planning points for when you have a client with extra GST exemption, next slide, will be to look at a late allocation of GST now, not because of the circumstance I described earlier, where the value has gone down dramatically, but more a circumstance where a client previously funded a trust, next slide, please, where there was a sort of affirmative decision not to allocate GST tax exemption to a gift to a trust, such that the trust is a non-exempt trust. But we are now finding later, kind of regardless of what the value is, if we have unused GST tax exemption that we'd like to allocate, we can go ahead and do a late allocation now and essentially just make either all or part of that previously non-exempt trust exempt now. Again, that may not necessarily be because we think we're in a moment following a gift where we've declined in value. This may be a circumstance where a client is just reevaluating their portfolio of trust structures and realizing that maybe based on their appetite for further gifting, they're not going to do anything with sort of some excess GST exemption that they have now, but they appreciate the adage that we, tell clients most of the time, which is, using it early is a better long-term solution because we have the opportunity for further growth to apply based on any allocations that are used now. So we may have a circumstance where a client who previously established a non-exempt trust is, reconsidering that decision and going to now apply their excess GST tax exemption to that, whatever the value of the trust is at that time, in the hopes, though, that they will have hopefully many more years and time to see that now exempt trust increase and continue to benefit their intended beneficiaries. Now, this has predominantly been focused so far on excess GST, but sometimes we have the reverse circumstance, and we really want to talk particularly about how post-death there are some strategic planning opportunities as well for dealing with gaps. So next slide, please. And actually just next slide after that already.
There we go. So this slide is, sort of our traditional joint revocable trust plan after the first death. So it splits into a survivor's trust, which holds the survivors half of community property and any of their separate property. The bypass trust, which typically holds the remaining exemption, estate tax exemption from the decedent. And then the marital trust, anything above and beyond what that exemption amount is. So if we go to the next slide, in order not to leave any exemption behind, in the scenario in which the decedent may have more GST exemption than estate tax exemption. In this situation, we would recommend looking at an exempt marital trust to be able to use the decedent's full remaining GST exemption. So what this looks like in the document is a structure that divides the marital trust into separate trusts. One that's fully GST exempt and uses the decedent's remaining GST exemption, and then the other consisting of all the remaining marital trust assets, and that trust is fully non-GST exempt. In the interest of time, I'm going to skip to the next slide, which is sort of the opposite end of the scenario. So let's assume in this scenario, the deceased spouse has more estate tax exemption than GST exemption. So in this case, we would recommend a structure that splits the bypass trust into GST exempt and GST non-exempt trusts, rather than funding a single bypass trust that may create that mixed inclusion ratio. Then I think we were going to go on to disclaimers real quick.
Yes. So recognizing we're running out of time, we just wanted to talk at the next slide, disclaimers. This is, again, something that is often coming up for clients, more in the context of thinking about, what is right for my beneficiaries. Once a parent has passed away, the beneficiaries may be contemplating whether or not someone who's designed to, under the current estate plan, inherit, if they don't need the funds, do they feel comfortable moving those assets through disclaimer onto the next beneficiary who would otherwise inherit? All we want to talk about in this case is that, particularly in a lens of having excess GST tax exemption over estate and gift tax exemption, that this is something that you might take a particular tax focus to and not just think about the personal financial situation of the family members. That this is an opportunity to maybe understand that if a disclaimer, the result of which causes a skip person to inherit through the estate plan rather than a non-skip person, there may be an opportunity for kind of global planning amongst the family to be more thoughtful about the use of the decedent's GST tax, particularly if they have excess GST tax. We'll move to the next slide and admit that this slide was really brought about, and sorry, on to the next one, because we really wanted the idea of local trains and express trains. So the local train is a consideration of state estate taxes. Next slide, please. We'll just mention that there are 19 jurisdictions, 18 states in the District of Columbia that still have an estate or inheritance tax that's applicable at the state level. Why this is relevant is that in planning for how to structure an estate for an individual living outside of California that may be subject to one of these states, to be aware of the fact that there are some planning opportunities to be aware that local state rules may have much lower exemptions that apply at the federal level. Why this is important, though, is in this structure, which creates what's called a contingent marital trust, a marital trust that is making a basically state-only marital election and Q-tip election, but not doing so at the federal level. This is to allow the bypass trust that's created to only be funded with the lower of the two state and federal exemptions, and then basically use up in this contingent marital trust the remaining balance of the federal election federal estate tax exemption, utilizing, however, a state Q-tip election in order to successfully avoid any of the state level estate tax, is just to be thoughtful about where it's most effective to use GST allocations amongst these different trusts. And I realize with that we're out of time. We'll advance to the next few slides and just say, the takeaway points out of your materials. We have a couple of checklists and other tasks to just take everything that we've talked about today and bring it top of mind for you. So we have checklists and takeaways for ideas that both practitioners to be able to identify when these gaps are happening. And then in part two, to take some of the proactive measures that we've talked about to, again, eliminate some exemption discrepancies that might have been created. And our contact information was in the materials. We're happy to answer questions because we realized we rushed a little bit at the end. But it was a real pleasure to be here today and to talk with all of you about, what was an exciting project for us to put together and which all originated from the lowly crummy trust. So, that is something that we're really cognizant of in creating these exemption disconnects.
This concludes today's program. We would like to thank our speakers today, Amy Takeuchi-Wanlas and Elizabeth Glasgow, for an excellent presentation. Our next program will be on July 21st, featuring Chang Che. Thank you all for joining us this afternoon.
Thank you.